I will be presenting in English today. If there's any problems in terms of understanding, we have some of our colleagues over here that we can also have conversations in Chinese as well. So my name is Alvaro. I'm CSO at Nsure, Head of Strategy. And Nsure is an open insurance platform for open clients. When we thought about implementing insurance in the DeFi industry, we saw that there is different concepts, not too explored of an industry segment, but you have seen models like mutuals, for example, arising in the last year and a half. When we arrived with a theme on how to conquer with insurance in the DeFi space, we actually decided to borrow the idea from the most established marketplace in insurance, which is based in London. This is the Lloyd's London model. It's basically one of the biggest insurance platforms, marketplaces to trade risks worldwide. It started in the 17th century, and I will go a little bit deeper about the concept in a little bit. Some of the innovations or concepts that we decided to implement that have not yet seen before in the industry are things such as the dynamic price for insurance. At this point, you can see some protocols which offer insurance that completely run out of capacity because of the functionality and the way of how these products are being offered. So we are offering it via dynamic pricing model, which is based on the real-time supply and demand. Supply and demand are actively impacting the price of the insurance itself. We also decided to combine in the protocol concepts like capital mining, where providing capital for most efficient MCR capacities in the protocol itself. MCR is minimum capital requirement, is one of the basics in terms of insurance to be able to cover the policies which are actively being managed in the protocol. And we decided to merge that with something that has been very popular in the last 6 months in terms of mining governance tokens. We have seen it with plenty of farms recently in DeFi. So if you are providing capital to the protocol, you are eventually also mining the governance token itself. And last but not least, we're basically an adapted model of the London Lloyd's marketplace to trade these risks and different protocols which users are engaging at a different level in DeFi. They can access this platform for eventually covering those risks. A little bit of background about Lloyd's. So it started as a coffee shop in the late 1600th century, and basically it was one of the meeting points for cargo owners, ship owners back in those times where globalization was starting to become effect. Imports and exports were starting to become more predominant in the landscape. They started to come together and feel like they wanted to calculate the risks that they were having in terms of if there were any shippings that were lost, boats or ships that were sunk, to be able to cover those risks in a calculated manner. So that's how it emerged basically, and quickly became into a model of the London Lloyd's, which we know today, which is the biggest and most established insurance marketplace at the global scale. On one hand side, you have the business flow, you have the interested profiles which want to take policies to cover whichever kind of situation it is, whether it's transport, logistics, e-commerce, and you have the flow itself, where the capital is provided from to be able to ensure this. And you have the central fund, Lloyd's itself, for providing the business, but you also have a second layer, which is the syndicate level funds, which is parties which are eventually interested in participating in providing coverage in exchange for the potential returns. So we adapted this model into a decentralized manner. This is the insurance landscape in DeFi today. So as of yesterday, we had $12.47 billion total value locked in DeFi, and not even 0.5% of this was insured or covered. The current active policies which are covering DeFi products is $52.5 million US. And as we know, it's a hugely exploited market with certain risks as well, where you might have, whether it's exploits at the protocol level, hacks, or different situations that users cannot predict and they would be interested in covering. So how does it work? What we decided to do with Nsure is basically take the model from Lloyd's London, and differently from how a mutual works, I'm sure that you might know some of the protocols currently active in terms of insurance, that they work as a mutual. If you're a policy buyer, you're also a capital provider, and you're a risk taker. All three profiles in that insurance model is basically the same person, the same user. So we decided to separate that. You can be a policy buyer, where you're interested in buying coverage for insurance. You can be a capital provider, which is deploying the capital and getting incentivized via capital mining, obtaining insured tokens. Or you can be a capacity provider, which is by staking the token itself, you provide the capacity for the different products to be insured. The way it's divided is that every time there is a claim, there is a policy which is sold, 50% is going to the capacity provider here on the right-hand side, Jeff, which is staking insured tokens. 10% is being reserved in a claim reserve pool for future claim resolution. I'll get into this later. And 40% goes into the surplus pool. The way the surplus pool operates is the same way that the main capital fund works in the US London model. As policies are sold and they eventually expire as well, that surplus pool grows and has a health situation which it can cover in case of any adverse effects, in case there's any exploits or any claims that have to be paid out. In order to have a higher degree of safetyness and coverage, it makes sense to have a reserve, what we call capital pool, in which you can stake as a user your Ethereum or stablecoins and in exchange get rewarded by mined Nsure tokens. So here's a little bit about the capital mining and the token staking. So on the left-hand side, you can see the capital pool is basically accepting any kind of base currencies, and in exchange you're getting the Nsure tokens. And it helps for a more efficient MCR, minimum capital requirement managed. So the capacity eventually for the covers itself can also be increased. On the right-hand side, you can see how it would eventually work if you want to directly provide capacity by locking your insured tokens. So the way this works is you have your tokens and you can choose as a user where you want to provide the capacity. So Nsure platform is going to have several different protocols that are going to be insured. And those protocols are freely choosable from the user perspective, where they feel comfortable with staking those tokens for providing that capacity. Now, one of the concepts that's more advanced concepts that we took from traditional insurance as well, and it's how insurance companies in traditional world manage to scale so much, is by having less correlated products in their portfolio. So we are allowing the users, if there is less correlation in the products, let's say one is a lending protocol and another one is a derivative protocol, there is no direct connection or overlaps in terms of the code, that the capital that is being locked for providing the capacity can be leveraged. So you can eventually use it at multiple venues for locking those insured tokens and providing the capacity. In terms of the pricing model, we believe this is one of the most needed concepts at this point in the industry. Even if it's a very underexplored segment, the capacity on the few venues that you can buy insurance from is completely oversold, basically. If you want to buy insurance today in a protocol like Compound, most likely it's going to be sold out, basically. So by implementing a dynamic pricing model, we are allowing users to eventually price discovery, similar to how AMMs work, how decentralized exchanges from today are working. That the supply and demand is finding the price discovery and enabling a fair pricing at every point in time according to the supply and demand. This also represents that if there's a protocol which everybody is willing to insure and provide capacity for it, the pricing will eventually increase because there's a lot of capital supply and many people are feeling that they're safe by providing that capacity in exchange for the potential rewards. And in contrast, if there's a lot of demand for a protocol that might be perceived as more risky and the capacity supplied is not as much, the price will eventually increase. So we allow for this efficient price discovery to happen as well. We have deeper explanations on this on our white paper, but if there's any questions afterwards, we can eventually go into it as well. So one of the core concepts in insurance is the claims. So if I have an insurance and there's a default and I want to have a claim to basically cover the risk that I was paying for in that policy, is the claim process basically. And this kind of concept has been explored in other protocols at this stage, but it is not so efficient at this point. Usually it takes several days, weeks time because it's done in a decentralized manner. Decentralized governance is playing a role here, and decision making is playing a role here. One of the core concepts that we implemented here, trying to provide some expert perception basically from the concept itself, from the claim itself, is the second stage over here, the agency assessment consensus. So on a decentralized way from the governance itself, we're incentivizing professional actors to become part of that agency assessment. Whether it's an auditing company in the blockchain space or some of the more renowned developers that actually can find code exploits and perceive those code exploits, they will be incentivized on a protocol level via governance to become part of it. But basically, to run it from top to bottom, it's a three-layered voting system. So if there's any exploit, any claim, the policy buyers that engage with that product, they would first have to arrange a claim, and it would have to pass with more than 50%. Then at the second stage, we go to the agency assessment, which would give their review on the case. If there is no contradictions from the token holders, from the community itself, then it directly passes, decision approved, and there's a claim payout. It's the agency assessment, for example, perceives that this was not an exploit that should be covered. The overall community, the decentralized governance platform itself, they can eventually go against this decision and challenge. We call it challenging the decision. And there is a time of 12,345 blocks for challenging that decision, in case that there would not be a consensus yet. And after that, the whole community would eventually be called in for the voting process. And if it passes, there will be an approval for the claim to be paid out. This is a little bit for our core team members. So we have Jeff, which is around as well, one of our co-founders. We used to be working in the past in venture capital. Then we have Alex, which is bringing the actuarial analysis and insurance expertise. He has 15 years experience in the insurance industry. He was working with AM, one of the biggest international insurance companies in the world. Then we have Lifan, our CTO, which has also extensive experience with C++, Golang. He was privately managing a whole team of more than 40 developers and is now working full-time with us. And myself, I have a background in venture capital. Prior to Nsure, I was vice president at JR Capital and spent my last 3.5 years in crypto as a VC. These are some of our partners. We recently closed a 1.5 million private round led by Base Ventures and other actors I believe you might know, like Mechanism, 3Com, AU21. And about our token distribution, 55%, so a majority will be going towards community distribution via mining. This will be released at a gradual scale, on a 14-year scale, so a gradual distribution. And as you can see, our private seed rounds that I was just mentioning about, we will have a foundation and reserve which will be active with the governance itself for the participation of the users who vote upon the funds and the management of the funds, and some for the marketing and operations. Last but not least, we just announced today that we're proceeding with our public sale, with our token generation events, also in a decentralized manner. We've been collaborating with Balancer for some time and agreed on the best possible solution in our situation, which is on the LBP, on the liquidity bootstrapping. So the functionality of it is similar to how Dutch auctions work, starting with the price ceiling and eventually going down over 2 days. And it will take place on October 20th. Thank you very much. Thank you, Snap vendors as well. And if there's any questions, please feel free to ask or find me after the event. Thank you.